Hi, everyone. Welcome and thank you for tuning into this NBI Podcast. I'm your host, Martin Lefebvre, Chief Investment Officer at National Bank. And today's discussion will be around the rise of active ETFs, a timely topic of high importance as NBI will launch 20 new ETFs in September. To do so, I'm joined by Tiffany Zhang, Director within the ETFs and Financial Products Research Group at National Bank Financial. Tiffany, welcome.
Thank you so much for having me.
Tiffany, I'm told you're celebrating 10 years at the bank. Congratulations.
Thank you. That's very kind of you.
Yeah.
I can't believe it's been 10 years.
Yeah, time flies. So before we dive in the main subject, can you tell us about the importance of your role in the evolution of the ETFs research team over the past decade?
Yeah, absolutely. I am really passionate for what we do here at the ETF Research Desk. So I joined the group on August 31st, 2015, exactly 10 years ago, and very fortunate to land on the team and started out as associate analyst right after completing my Master's of Finance program. And over time, I've taken on more senior roles, and my team has expanded from 3 to now 5 people. And honestly, it's really humbling to work alongside such great colleagues on the team and also across the bank. And as you said, Martin, the ETF industry, it has evolved dramatically over the past decade. And we've been just constantly really busy answering client questions and also putting out reports that keep our readers up to date regarding what's happening in the ETF industry landscape. And every day we need to learn a lot of new knowledge to stay ahead of new products that are becoming increasingly sophisticated. And that's actually, I think, a really fun part of my role. And it's busy, of course, but looking back, I think I feel very fulfilled knowing that through our team's effort, we have helped so many clients along the way.
Tiffany, you mentioned the growth of the ETF space in Canada and throughout the world. Let's focus specifically on the actively managed ETFs in the country. Can you tell us what factors have contributed to the explosive growth in the recent years and maybe what is driving this surge in popularity?
For sure. So we do track the growth of ETFs, including active ETFs, very closely. We've had actually active ETFs in Canada for at least 20 years now. It's not a new development. But certainly in the past 3 to 5 years, the growth rate of active ETF has accelerated to the point now in Canada, when we look at the number of products, more than 50% of the products are actively managed or rules-based. They do not track any published indices. And that's also the case in the US. And so I think both the supply and demand side has to do with the growth of the active ETFs. So what I mean by that is on the demand side, when I first started, most of the investors, they were using ETFs in a passive way. So ETF was almost synonymous with passive investments. Investors use them to get passive exposure into, Canadian equity, US equity, and global equity. And then they also use passive fixed income ETF to get exposure to mostly Canadian bond. But over time, the investor demand has shifted beyond simply getting plain vanilla passive exposure. There's also the demand to get global diversification and also high and tax-efficient ongoing high distributions, and also portfolio insurance and protection during drawdowns, as well as some niche asset classes and themes. And so all of these demands are better met with active ETFs that are more flexible. And then on the supply side, we have a very competitive marketplace. We have 44 ETF issuers in Canada right now, soon to be 46. Sun Life and Capstone, they have filed preliminary prospectus to launch ETFs in Canada. So by the end of the year, likely we'll have 46 at least ETF issuers in Canada. And in the US, they call it a terradome. In Canada, I wouldn't say it's such a cutthroat environment yet. However, it is very competitive. And so in order to differentiate, simply launching another Me Too S&P 500 ETF wouldn't help too much in raising assets. And so what we see the ETF issuers do is that they launch ETF series of mutual fund or standalone ETF that replicate their existing mutual fund strategies that can lean into their star portfolio managers or successful strategies that already have a really wide following or popularity and track record on the street so that the products can be differentiated. And so I think the need of the ETF issuers to stand out and also the demand of ETF investors becoming more sophisticated, that creates a perfect environment for the fast adoption of active ETFs.
So you mentioned that the demand for ETFs went from passive to active, and you mentioned that for the time being, most of those are transferred from mutual funds, let's say actively managed mutual funds, to ETFs. What are other current trends in active ETFs? What are you seeing? What's really popular right now?
Well, there's actually several different trends emerging. I can talk about one for now, and we can delve into the other ones. So the one that I'm seeing right now is the boundary between active and passive is becoming increasingly blurry. I know we are talking about active, Martin, and this entire episode is about active, but I think the distinction between active and passive really isn't the be all and end all when it comes to product selection in ETFs. And so here's what I mean. So for active ETFs, now they are increasingly using passive ETF as underlyings. So two examples are in Canada, two of the largest active ETF category are asset allocation ETFs and the option strategy ETF. They make up more than 40% actually of the active ETF landscape. And so for these ETFs, oftentimes the underlying portfolio are index tracking passive ETFs. And then for the asset allocation ETFs, the portfolio manager would have active discretion over, when to rebalance, what products to use, and how to do the rebalancing. And then for the option-based ETFs, the portfolio manager would actively manage the option writing program to offer that high and tax-efficient distribution for clients. So the active now is becoming more passive. And then on the passive side, they say indexing is a series of active decisions. So there's always been an element of active even in the indexing business. But I think it's getting more active-like because indexing are becoming more complicated. So I think the index right now, they have to more rely on the human judgment and the expertise of humans to really define the investment universe and then set the criteria for what we include in the portfolio and even the ongoing maintenance. And so I'll give you an example. We have several index tracking artificial intelligence ETF in Canada and also in the US. But when we lift the hood and look at their underlyings, they look vastly different. They don't look at ETFs that fall under the same category at all. And so the reason is in the index design phase, the analysts at different index shops, they have different criteria or different definition of what is AI, right? And what criteria and what methods to use to screen for AI companies. And then they have to monitor the index in an ongoing basis so that their index construction rulebook stay current and relevant. And if not, they have to make modifications. And so that really sounds like very active to me. And so all of these nuances mean that when clients come to us, we typically don't start from the active versus passive distinction, but rather we look at what is exposure that the client is looking for, and then we map that into the desired ETFs. And then we take additional steps in analyzing the ETFs, and then we present a menu of options to the clients.
You mentioned exposure and perhaps diversification. You also mentioned option strategies. Are you seeing more alternative asset classes like maybe private credit or real assets entering the ETF space? Is that something that's more and more popular?
Yes, it is actually. We have few ETFs in Canada and US that are already including some of these more alternative illiquid type of investments in their portfolio already. Of course, they have to abide by the illiquidity rule, meaning that they need to limit those illiquid investments to maximum of 10 to 15% of the portfolio. But, these kind of products are coming to the market. And I wouldn't be surprised if we have more and more of these kind of products. I've read articles of how in the US, the number of public stocks have declined from the peak of 8,000 in 1990s to now more than 4,000. And that's because of the growth of private equity. And then that also fuels the demand for private credit, which I think the market has grown tremendously to close to $2 trillion globally in asset under management. And so if our collective marketplace becomes more private, for sure, these kind of investments will find their way into ETFs. And it's not without challenges, though. I think transparency and also liquidity, that's really the biggest challenge for these kind of ETFs. So until an ETF can find lots of natural buyers and sellers on the secondary market, their bid-ask spread is determined largely by the underlying liquidity. So the more illiquid the underlyings are, the bigger the bid-ask spread for an ETF. And so I think the availability of these ETF will be constrained by whether market makers can find liquid proxies for, say, a toll road or airport or some private loans. But we do see ETF in the US that include private equity in there. One ETF, XOVR, included SpaceX in the portfolio, and since then have attracted a couple $100 million of inflow. And another ETF, PRIV from State Street, have included private credit in the portfolio, also got some interest. So certainly the ETF providers, they are attempting to offer innovation in this area. But given all the constraint, I think it likely is going to be a small component in the ETF landscape.
Tiffany, let's go back to a portfolio construction and talk a little bit more about diversification. What type of role do you see actively managed ETF play in portfolio diversification?
Yeah, so that's a very good question. And we do see that both active and passive ETFs offer diversification benefit to the portfolio, but even more so with active ETF because it's able to access broader opportunity set. And so what we see this year is that investors are increasingly allocating to international equity and fixed income via active and passive ETFs. So I know, Martin, at CL office, your team have been recommending increasing allocation to EFA for a while now, and it's really the best performing equity compared to any other regions globally. And I think what's happening in the ETF space is that the ETF investors, they have been overly concentrated in US equity for the past decade or 15 years, which really has been the best performing asset class. But all of a sudden this year, the US dollar is depreciating, is dragging on returns, and then also the US exceptionalism is being challenged. And we had the sell-off in April from the tariff. And so investors all of a sudden realize that they need to diversify outside of the US, and they ramp up their allocation into international via ETFs. And I think in the exposure to international, be it equity or fixed income, ETF is really an important tool because without active ETF or active funds, really we have to go down two routes, right? One is we have to be our own active portfolio manager, or two, we have to go entirely passive. And so let's talk about both of these. The first one, we can be our own portfolio manager for sure. I can manage my own maybe North American equity portfolio, but my portfolio will have really large home country bias and sector concentration, and is really constrained by how I see the world. And I wouldn't really feel comfortable stepping outside of North America and say buy a Japanese stock or some French companies because I'm not familiar with them at all, let alone managing all the currency and also the withholding tax implication of investing internationally. And then the second route is go all passive. We do see some clients using entirely passive ETF for international, but I think there's also some concerns and risk, right? So we talk about the concentration of the US equity benchmark. Top 10 stocks in the S&P 500 make up 30% of the allocation. But when we look at international countries such as UK, Germany, France, their top allocation in the top 10 stocks are even higher, even more concentrated than the US. And their sector also is more concentrated than the US. And so some clients are really concerned about this, and they would rather have active management for international exposure. And for fixed income, it's mostly predominantly active for managing, different kind of bond exposure and allocating to different countries, depending on their yield curve and currency situation. And we can talk about fixed income as well, which I think is really a huge growth area in the active ETF landscape. But having said that, I think active is really important, but the onus is really on the investors to do all the proper due diligence. And my team really is here to answer all the client questions. And if you are ever curious about any of the products, please come to us and we can help you with ETF product selection.
Tiffany, I think you've made the role of active ETF pretty clear. You mentioned earlier there were about more than 40 suppliers right now. And as I said in the intro, National Bank Investment is about to launch 20 new actively managed ETFs. What do you think the landscape will look like in 3 to 5 years?
Oh, it's really difficult to predict. I wouldn't have predicted that we would have this many active ETFs in Canada, and also we would have Bitcoin ETFs, we would have split share, preferred share ETF, CLO ETF. All of these amazing innovation would have seen that. But I think two trends is pretty clear. One is that there's going to be a trickle-down effect that's going to still happen in the ETF landscape. And so what I mean by that is some of the strategies or ideas that are popular in the institutional space can trickle down into the retail space via ETF and vice versa. So one example is we mentioned earlier the CLO ETF. Traditionally, this has been an institutional asset. But now we have 6 ETF issuers in Canada launching CLO ETF. And many of the retail investors really like them due to their high distribution yield and also their lower drawdowns during sell-offs. And so the other direction also happens. Crypto asset ETF, traditionally that's a retail asset. Most of the crypto ETF or crypto investors are retail investors. But now, based on the certain F filings, we have seen many U.S. institutional investors, state pension funds and endowments and large family offices and different kind of advisory firms, they have embraced U.S.-listed Bitcoin ETFs. And so I think ETF is all about democratizing access to investment ideas. So whatever is popular in one part of the finance world will likely be wrapped up in an ETF and get delivered to other market participants. And another trend I think will likely happen is active ETF may have wider adoption among different kind of investors. So right now, most of the investors in active ETFs in Canada are retail clients, the online discount investors as well as the financial advisors. But I think we have seen, institutional clients globally use active ETFs. One use case could be to access some of the niche asset classes and themes where the institution do not have trading or research infrastructure for. And there could be other use cases such as, alpha generation or cash management. All the cash ETFs in Canada are active. And here by institution, I really mean, some of the asset owners such as pension funds and insurance companies, as well as the asset managers who manage their funds using ETFs. And so I think as the liquidity profile of Canadian ETF improve and also their fee come down due to the increasing competition, I think they will also get traction from the institutional space. But overall, I think the active ETF and the ETF overall, the growth rate will likely be here and it wouldn't slow down in the next 3 to 5 years.
Oh, okay. So by listening to you clearly, I think that the future is in ETF, and obviously actively managed ETF will play an important role in that. Tiffany, thank you very much for your time. It was a pleasure having you today. And for everybody listening, thank you for tuning into our NBI podcast. We'll talk again next month.